The closing entries for a merchandiser are very similar to those for a service company. We just have a few new accounts that we have to take care of. The service company's first closing entry closed out revenues. Revenues have a credit balance, so we would close them out with a debit to the revenue accounts, and my credit goes to that new account used just for closing entries called income summary. How is that going to be different for a merchandiser? Well, what does a merchandiser call its revenues? Sales. So the process is just the same. It's just that the merchandiser calls its revenue sales. So when you go to close out revenues, make sure you pick up sales when you debit those accounts. The service company's second entry closes out expenses. They have a debit balance, so we close them out with a credit to the expenses. My debit goes to income summary. How about for a merchandiser? What is one new, very important expense account that the merchandiser has? Cost of merchandise sold. Cost of merchandise sold is an expense. So when we go to close out these expenses, we need to close out cost of goods sold with the expenses. In addition, though, there are two more accounts that we're going to close out with the expenses that really aren't expenses, but they have a debit balance like our expenses do, so we're going to close them out with the expenses, and that's going to be my two contra accounts to sales, my sales returns and allowances and sales discounts. So when we close out expenses, we remember that cost of goods sold is an expense. We also will close out sales returns and allowances and sales discounts. They aren't actually an expense, but they have a debit balance like the expenses do, so we'll close them out at the same time. My third and fourth closing entries don't change at all for a merchandiser. They are exactly the same as they were for a service company. The third closing entry closes out income summary. We find the balance in that account. If it has a credit balance, then we'll close it out with a debit. If it had a debit balance, we'd close it out with a credit. The other part of that entry goes to retained earnings. The amount of that third entry is whatever the balance is in income summary, and it will be my net income or net loss. My fourth closing entry closes out dividends. They have a debit balance. I close out dividends with a credit, and my debit then goes to retained earnings. What accounts do we not close out? Well, on this list that I gave you, everything from cash down through retained earnings would not be closed out. All of the remaining accounts then will be closed out. Don't close out the balance sheet accounts, and that would be cash down through retained earnings. All of the others need to be closed out. So let's now make our closing entries. REID was our silly word for the service company. It would also work for the merchandiser. R says, first off, we close out what? Revenues. Revenues have what sort of a balance to begin with, debit or credit? Credit. So we're going to close them out with a debit. What sort of revenues did we have in this particular example? Sales, very good. And what else did we have? Interest income, very good. So I had two revenues. I had sales and interest income. I will debit both of those accounts to get their balance down to zero, and my credit goes where? Income summary, that new account that is used to facilitate the closing process only. So I'm going to debit sales, I'm going to debit interest income to get their balance down to zero. R. R-E. E says we close out what? Expenses. Well, let's look at my list and tell me some of the expenses you see. Delivery, sales salaries, office salaries, interest, depreciation, cost of merchandise sold, very good. Now do me a favor, don't start writing quite yet. There are also two other accounts that have a debit balance like my expenses do. They're not really expenses, but I'm going to close them out right now along with the expenses. What are they? The two contra accounts to sales, very good. Sales, returns and allowances, and sales discounts. So we have lots of accounts that we need to do what to? Debit or credit them? Credit them. Lots of accounts we need to credit. So let's skip the first line in the journal entry for the debit. We'll come back to it. Let's skip that debit line. We're going to come back to it. And then let's record all of these credits. And yes, we have quite a few. It does not matter in which order you list those. The order doesn't matter at all as long as all of your debits come before any of your credits. Lots of accounts to credit to get their balance down to zero. We're going to make one debit for the total, and it goes where? Income summary. So we've closed out revenues. All of my revenue accounts have been debited, got their balance down to zero. We've closed out my expenses plus my two accounts that are contra accounts to sales. We credited all of those accounts to get them down to zero. That's R and that's E. REI. Third closing entry says we need to close out what? Income summary. Now, before we can close out income summary, we have to do what first? See what's in that account right now. Draw a T account. I don't believe I gave you a space here. I want you to understand that you need to figure up on the side of your test or wherever it is, put you a T account to see the balance in that account. Let's post those first two entries. The first entry did what to my income summary account? Debit or credit it? Credited it for $135. Good. That's when I closed out the revenues. The second closing entry did what to income summary? Debited it for $86. That's when I closed out the expenses. That leaves me right now in income summary a credit balance of how much? 49? What does that number 49 represent? My net income. How do I know it's income and not loss? Well, the 135 was my revenues. That's bigger than the 86, which is my expenses. The difference between revenues and expenses is my net income. If we want to close out income summary, right now it has a credit balance of 49. How will I close out income summary? With a debit to income summary to get its balance down to 0. And the credit goes where? Retained. After we make that entry, we like to look at it and think to make sure it makes sense. Well, let's see. We had a net income, didn't we? More revenues than expenses. We had a net income. Earning a net income does what to the net worth of my business? Makes it go up. Well, in my journal entry, I had to credit retained earnings. Crediting retained earnings does what to that account? Makes it go up also. So a net income should result in that third closing entry with an increase in my retained earnings account. REID, the fourth closing entry closes out what? Dividends. Dividends has what sort of a balance to begin with? Debit. So I will close out dividends with a credit to dividends, and the debit goes where? Retained earnings. Debiting retained earnings makes it go down. Capital or equity goes down with a debit. That's because when we pay dividends, that makes my retained earnings also go down. So, closing entries for a merchandiser were really just the same as for a service company. First closing entry, we just had to remember that sales was revenue. Second closing entry, we had to remember that cost of goods sold is an expense. Plus, we had to pick up sales returns and allowances and sales discounts. Third closing entry doesn't change at all. Fourth closing entry doesn't change at all. Do we close out retained earnings? No, that's sad. That says you're worth nothing. When's the only time we close out retained earnings? Going out of business, and that will not happen this semester.